today, folks. My name is Tyson Mavar. I'm one of the Chevron-focused retirement advisors for the retirement group here in Texas. Today, we're going to be talking about the Chevron pension interest rates. Many of you probably saw this week the IRS published the January corporate bond interest rates that have very big implications on the lump sum payouts for anybody that's approaching retirement especially. So I'm going to go ahead and zoom in here so we can compare these rates historically over the last 2 years at least. So here's what came out in January. The first, second, and third segment rates, those are based on short, intermediate, and long-term corporate bonds. The second segment rate being the most relevant of the three, carrying the most weight, for instance, because it's 3 times more relevant than the first segment rate. But all three rates went up. Now, first, let's review the timing issues with the Chevron lump sum pension. The company will look back to the third, fourth, and fifth month prior to the month that you are commencing your benefit. So here we are in February. They just released January's rates. January's rates won't be relevant until folks that are leaving in April, because April is going to look back to not March or February, but January, December, and November, the third, fourth, and fifth month prior to April in this case. So if you're somebody who is on the fence between leaving in March and April, might be a consideration to leave and commence your benefit in March, which means you basically have to leave by the end of February to get a March 1st commencement and not have January be a part of your calculation. Look at this on the second segment rate. The rates have gone up 30 basis points. And the relationship we remember is for every 1% increase to the rates, you can expect about a 10% drop in your lump sum. And of course, January is only 1/3 of the total calculation, but that's a pretty substantial increase for 1 month. And if we see these things take off throughout 2022, you could see a slow deterioration or maybe even a fast deterioration of your lump sum. And you need to be, especially for those of you considering leaving the company soon anyway, in the next couple of years, I would say, reevaluating your retirement plan to see what this interest rate impact has on your specific lump sum in dollar terms, and compare that to the benefits of continuing to work at the company. So you have a true analysis of what are the costs of staying, what are the benefits of staying. And I think this will help you in determining the best time to leave, to not leave any money on the table and not work for free. First and foremost, we've seen rising interest rate environments in the past that resulted in people working literally for free for the company because the losses in their lump sum were close to equivalent to what they were earning in salary and other benefits that active employees receive from the company. Let's go back here. We saw some very low rates back in December of 2020. 2.26 was the second segment rate. So we've already seen 75 basis points roughly, could be a 7.5% drop in lump sum since then, just as a result of the interest rates, of course. Your added service with the company will grow your lump sum. As you get closer to age 60, you'll be aging out of penalties, which will also grow both your lump sum and annuity. But there's some moving parts here that we found far too often people do not have a good grasp on. And it's very important that you get a grasp on these as you get close, so you don't leave tens of thousands or even hundreds of thousands of dollars for some folks on the table because these rates moved too quickly on us and you had less money in your pension as a result. Fortunately, looking back at March 2019 at the bottom here, you can see rates are still quite a bit lower than they were 2 years ago. So we're still in a relatively favorable environment to leave the company and take a lump sum historically. But there's a risk of staying at the company and a risk of leaving your pension at the company is what these rates are going to do to your lump sum. So I encourage you to spend some time with us if you haven't done so already, or if it's been a while since we've had a chance to talk. Please reach out to us at the home office. Our phone number is 800-900-5867, and somebody will help you get on the calendar of one of our Chevron-focused retirement advisors. You can also email us any questions or a request for a meeting at info@theretirementgroup.com. This QR code here on the bottom left will get you on one of our Chevron-focused advisors' calendars. And this QR code here on the right will get you a link to our LinkedIn page where we publish a lot of content like these videos to keep everybody up to speed with what's happening with interest rates, as well as what's happening with the tax code as it pertains to the Chevron benefits and some of the decisions and some other retirement strategies that we found valuable to Chevron employees and folks that are approaching their retirement from the company. With that, we're going to wrap it up today. We appreciate everybody joining our webinar series on interest rates. Hope everybody has a good, safe rest of the week, and we hope to talk to you all again very soon.
And thank you everybody for taking the time to join me today. Again, my name is Wesley Boudreau, one of the financial advisors here at the Retirement Group. Today we're going to talk about the Chevron retirement process and what it means to retire on purpose with purpose. Now before I get started, I just want to remind everybody that we are not employed by nor are we affiliated with Chevron. And then throughout the process of this webinar, you'll see on your screen there's a couple of items. There's a Q&A box. So if you have any questions you'd like me to address or one of us follow up with you on, go ahead and take the time to jot that in there, and we'll be sure to try and address that at the end of the webinar. If we don't get to all of them, we'll follow up with you as well. And keep in mind your information is anonymous, so feel free to ask that. Your name will not be shown. Also, there's a chat box where periodically we will be putting some information in there that's good to follow along with. Different items like how to follow us on LinkedIn, so you can stay up to date on any notices we give you or Chevron changes. How to set an appointment with myself or one of the other advisors in the office. Also, I think that we may put in a survey there. So if you have some time to fill that out, that may be worth your while. If you let us know how this went, any suggested changes we should focus on, or any new topics. And if you take a couple minutes to do that, I think we might be sending a box of cookies your way. So it may be well worth it. But before I get started, I just want to remind everybody who hasn't been on a call in a while or hasn't worked with us who the Retirement Group is. Again, we are an independent financial advisory firm that focuses on working with corporate employees and helping them transition into retirement. We've been doing this for about 30 years or so, and we've worked quite extensively with Chevron and Chevron employees. And the reason we only work with a few different companies is it allows us to actually have a deeper focus and understanding of what your actual benefits plans are. So we can help hold your hand through that retirement transition process, make sure you avoid a lot of common mistakes, and obviously increase your retirement nest egg. And in turn, if you want to work with us, hopefully increase that throughout retirement as well. We've got offices throughout the country, so rest assured if you need to sit down face-to-face, we can still accommodate you that way. But obviously, with the times we're in right now, if you want to have a web meeting or phone call or email, we can do all that as well. At the end of the day, if there's anything you take us up on, is go ahead and take us up on our complimentary cash flow analysis. You'll hear me talk about that once or twice here later, but there's no way to really determine if you're going to retire on purpose with purpose unless you know where you stand. And by going through that cash flow analysis, we can give you an idea of where you stand, and we'll be happy to tell you the truth, whether you can retire or whether you should work a couple more years. But we can go through various scenarios to let you know the different options so you can determine the best day to retire, and also make sure you avoid some different mistakes that we see from time to time as well. Now, as far as going through the retirement, there's really kind of a checklist we put together. It's pretty simple, and it's something you can do on your own. But we do believe by working with the company, we can kind of hold your hand through that process and make it a little bit more smooth. First and foremost, you need to make sure that you're comfortable with the retirement process and understand your emotions. We do an entire seminar on the emotions of investing and the emotions of retirement. But at the end of the day, I mentioned that cash flow analysis. Our job is to run through the financial numbers and let you know, financially speaking, whether you're ready to retire or not. Emotionally, you may not be ready to retire. I can't tell you how many people I've worked with where they were great on paper. They could have retired 5 years ago, but they're still working because that's their livelihood. That's what they associate it with. They don't know what they're going to do if they walk out that door and get stuck at home. They don't have hobbies. They don't know what's coming next. Or the spouse may say they're not ready for you to come home at this point as well. So just make sure that whenever it comes time for retirement, you are comfortable with that and you're ready to retire, and you're not making any rash, quick decisions, especially when we see different changes in the industry and EOIs and things like that coming about. You want to make sure it's something that you're comfortable with before you pull that trigger. Now, at the end of the day, when it comes time for retirement, in retirement, generally speaking, we're going to focus on trying to help you decrease your risk and your volatility. Because again, what's going to happen in retirement, it's a little bit more nerve-wracking to see market volatility as opposed to having 10, 15, or 20 years of investment ahead of you. Now, generally speaking, again, most retirees are going to want to reduce their risk, and we'll be happy to review that with you. However, everybody's different. I've got a Chevron retiree that we helped retire about 5 years ago, who I'd say is extremely aggressive. His true goal is really to pass on a big legacy for his daughters. However, we've sat down and gone through the plans multiple times, and found out that it's best to really kind of split that strategy. We've got one strategy where it's set up to build that legacy he's looking for, and we're okay taking growth because it's not going to affect us on the retirement strategy, where we've got another portion of the assets set up a little bit more conservative, and we know we're looking at the different income options associated with it to make sure that he and his wife are taken care of for retirement, so that growth strategy can go up or down over the next 20, 30, hopefully 40 years if he lives that long. So again, everybody's different. By running that cash flow analysis and getting to know you, we can have a better idea of what you're looking at. And then as far as the process, we want to increase your retirement income. I mentioned again that cash flow analysis and working with you prior to retirement, understanding your benefits will help us get you started off with a higher nest egg so we can increase that income right there. And then by working with us on the investment strategy, we can focus on that as well. But again, one of the other ways to help increase that income is helping make sure you keep that income and reduce the taxes. So we do a lot of tax planning strategies with our clients and prospects and making sure that we reduce the amount of taxes they will be paying on the retirement process initially and ongoing if they're a client. So we think you can do all this stuff on your own, but again, it gets a little complicated. You may not have the full expertise, so we do recommend working with a team like the retirement group. But again, if you're doing it on your own, you can still use this as a sounding board. It's still important to run through this review to make sure you're doing everything correctly. Now, let's talk about some of the different things we see coming up for the retirement transition process. We'll talk about some potential lump sum changes based upon interest rates, which also can affect inflation going forward. We'll talk about how real estate actually impacts the retirement process, which is something most people don't talk a lot about. And then we'll talk about some different mistakes and what it means to work with a team versus doing it on your own. Now, first, let's get into the source of income you'll see when you retire from Chevron. There's really three primary sources of income. You're going to be looking at Social Security, which you have that option of taking as early as age 62 or deferring all the way up till age 70. Now, we can go through a full detailed Social Security analysis to show you all the different claiming strategies associated with that if you like. Then you've also got your 401k, where you and Chevron have been making contributions to it along the way, and now you've built up a certain amount and you can start taking distributions from that. You can keep it in the 401k plan or roll it over to an IRA if you want. You've also got your pension. We're going to talk a little bit about the lump sum today, but the pension option is a defined benefit plan, in which case there is a formula to determine how much of an income annuity you're going to get on a monthly basis. You can decide to take that, or you can actually decide to turn it over into a lump sum to try and outperform that if you want to. So that could be an income annuity as far as the pension source, or you could take that, move it to a lump sum in an IRA, and take distributions similar to how you would from the 401k. And then the fourth that some people may have is real estate, depending upon what you're looking to do with it. If you own real estate and you're not looking to simply just pass it on to your beneficiaries, there may be some other ways to generate some retirement income off of that. We'll talk about that in just a moment. Now, first, let's talk about the lump sum. Now, again, I mentioned that the benefits for the pension plan is a defined benefit plan, in which case there's a calculation looking at your years of service and your final average pay to determine actually how much you're going to get on a monthly basis. From there, you can actually decide to take that pension as a monthly income to yourself, or you can look at a joint and survivor option if you want to make sure that you're taking care of your spouse as well. Or you can say, hey, I want to take a lump sum. I want to try and manage this on my own. And that's where interest rates come into play and where we're going to see some changes going forward. So if we look at the interest rates here, what's going to happen is when interest rates go up, your lump sum will go down. When interest rates go down, your lump sum will go up. So the way they look at this is think about it like a mortgage. When interest rates are low, you can afford a bigger house or a bigger mortgage. What's going to happen is, let's say if Chevron is telling you they are going to pay you $3,000 a month for the rest of your life, what they do is they go and look at your age to figure out how close you are to your life expectancy, to figure out how many years are left on that payment. And they look at interest rates to figure out how much of a lump sum they're going to give you. If interest rates are low, they have to give you more money for you to go out and try and recreate that same annuity payment. So that's what we've seen over the last year or so with the pandemic is a drop in interest rates. However, chances are we will see interest rates come up, and the question is by how much and how long will it take for those to come up. But we look at the seesaw effect right here. Again, as interest rates go down, your lump sum goes up and vice versa. Depending upon your age and everything, generally speaking, a 1% change in interest rates will correlate to about an 8 to a 12% change in your lump sum. So if you have a, let's say, $1 million lump sum right now and interest rates go up by 1%, it could drop by 10%. So that could go down to $900,000. So depending upon what your income is, and if you're looking to hang on for just 1 year, if you made $100,000 a year, then you could essentially be working for free that last year. So that's why it's really important to run that cash flow analysis we talked about in the review. We're working with a lot of individuals right now at Chevron that we've over the last couple of years we've kept an eye on these rates because what they do is they move monthly. Let's take a look at them here. I'll zoom in just a little bit. Now, as far as the interest rates, the way that they're used to calculate the lump sum is there's 3 interest rates. There's the Pension Protection Act segment rates. And the first segment is going to correlate to the first 5 years of retirement. Second segment going to be the years 6 through 20. And the third segment is going to be for years 21 and beyond. So the second segment has the heaviest weighting since it's going to capture 15 years of retirement. But if we look at this chart here, you can see how over the last 5 years or so, the interest rates have been on that slow decline, and then the pandemic exacerbated them, and they actually dropped quite a lot. And we'll see where we are pretty low right there, and we're actually starting to tick up just a little bit. So it's a question of how much inflation comes into play and how quickly will they go up. Now, one of the unique things about Chevron versus other different companies in their pension plans is Chevron actually updates their rates on a monthly basis. Others usually do it on a quarterly basis, or some even once a year. So you've got a little bit more flexibility in when you want to commence your benefits on this and watching those interest rates. So again, the biggest issue is if you're within a year, especially a year, but if you're within maybe 3 years of retirement and you're leaning towards a lump sum, give me a call. We need to look at monitoring those interest rates for you, because again, it could mean whether or not you want to work a couple more months or even another year for a reduced salary versus your full salary, depending upon how those interest rates change. Now, there's also factors as far as the age penalties and things like that, depending upon your age, but we get into those more in the webinar that we go over the pension plan or one-on-one. Now, we talked about interest rates changing coming up and how they could affect the lump sum. Some other things they could affect would be real estate and inflation. So real estate generally or historically has not been considered an investment portion for retirement. But if we look at how interest rates have come down and driven up the prices of a lot of the real estate, coupled with the pandemic driving up real estate in the suburban areas, this could be an opportunity to review that as a potential asset within your retirement process if you need that or you want that. Now, one of the things that are a little bit different here is we're a little bit less concerned than what we were with 2007 and the crisis of 2008, because there was more of a supply issue there. Now it's a demand issue where we still have a lot of demand for housing. So we don't see a big drop coming up. We depend upon interest rates. If they rise, we may see a leveling or so. But there's different ways that we can look at this. If you own your house or own a condo or something like that, and you have equity in there, then that may be something that if you need it for retirement, you could tap into. And we work with a lot of clients that do it in different ways. One of the best ways, or the simple way, is if you're downsizing. A lot of people are downsizing. They may have the house that the kids grew up in, and it may be too big. So maybe it's worth $500,000. You sell it and go buy something that's worth $300,000. Now you've got $200,000 in equity that can boost your retirement income savings if you want to. Maybe the numbers are bigger. Maybe the numbers are smaller. It just depends. Another option is simply moving to a different area. I'm working with 2 people right now that live up north, and one's looking to come down towards Texas and get a house in San Antonio. So she's going to actually be moving to an area where it's cheaper living, so the house will cost less, and she'll avoid the state income taxes as well. So another way to save. We ran the scenario in the cash flow analysis to show those different options. So we saw side by side where she was going to be, I think making about $150,000 difference on the house, and then saving another $6,000 to $8,000 a year on taxes. So it stretched out the retirement quite a bit. Another one is actually moving to Florida and getting a similar size house but a little bit cheaper. And again, same situation, avoiding the state income taxes there. So that's one option if you're looking to simply downsize, or if you're looking to move states as well. Another option that some people look at, and we don't get into too much detail, is a reverse mortgage if you're looking to stay into it. So you have questions on that, let us know. But again, that's more kind of a last resort situation. And then again, we see real estate not moving too much because the replacement costs are so high right now as far as what it is to build a house. So that's why we do see that market staying somewhat stable, barring again any major interest rate changes. And so talking about interest rates, that's a big culprit going forward. We're looking at the low interest rates right now and the effect of inflation going forward. We do know that interest rates are so low, eventually they're going to have to come up. The question is how quickly and by how much do they come up? Once that starts happening, we'll start to see inflation. I know everybody has seen the price of different items go up during this pandemic, and we've seen the CPI jump quite a bit over the summer as well. But eventually, long-term inflation may come into play. So you need to be very aware of that when it comes to time to invest, and you're based upon your allocations. The typical, diversification between bonds and stocks may not work quite as well going forward as it has over the last 30 years because we're coming off a bull market for bonds because, again, those interest rates in the 80s were so high. As they move down, bond prices move up. So the opposite is going to happen here. As interest rates move up eventually over time, bond prices will come down. So you're not going to have quite as much yield or quite as much performance on that. So that's why it's really important to run that cash flow analysis and find out what you're trying to achieve. And we can determine a sound portfolio strategy to help you meet those income needs with as low risk as possible. And at the end of the day, we do again recommend working with the team to make sure that you avoid a lot of these different mistakes. It's something you can do on your own, but again, it's really important to have at least a sounding board, so at least run it through us initially. And if you want to work with us, that's great. If you want to do it on your own, then we give you some information at least. If you're working with somebody else right now, that's okay. We do recommend getting a second opinion. We even recommend our own clients do that periodically. But if you are working with somebody, make sure they have a deep understanding of the Chevron plans so they don't make any mistakes. I can't tell you how many times I've sat down with individuals, even with their advisor, that had made mistakes and cost their client tens of thousands of dollars in the retirement process. So it's very important to understand that. Also, make sure you understand their fee structure when you're working with somebody. At the retirement group, we are fiduciaries. We're transparent on our fee structure. It's not a one-size-fits-all firm, so our goal again is to run through that cash flow analysis and then back into different investment strategies and find out one that best suits your needs. And then you also want to make sure, again, you're working with an investment management team. Myself, the other advisors here, we can't do everything all the time. So we do rely on our back office. We also rely on the support from Schwab, who we clear through, to help with a lot of the investment management expertise. And then also help us with the support. And at the end of the day, again, you want to make sure you run that cash flow analysis. It's detrimental to know where you stand before you make any investment decisions. You want to make sure you update that periodically as well. So if it's been a year or longer since you've run one with us, give us a call and we can go through and update that with you as well. Now, at the end of the day, that cash flow analysis right now, I think it's only about 30% of Americans have one. So if you spend about maybe 10 to 15 minutes with us on the phone, we can gather some information and get that put together for you. We'll get it back out to you in about a week or two, and we'll be able to go over that with you and then tweak it from there if you need any specific updates on it as well. And then with that, I'm going to wrap it up. I want to thank everybody for taking a little bit of time to join us and go through this retirement process. But the best way to resolve any questions you have is to give us a call so we can go through that one-on-one because everybody's unique and different. So just give us a call at 1-800-900-5867. We're more than happy to help you out. You can also hold your phone up to the QR code on the screen if you want to. There's an option to schedule a meeting with myself or one of the other advisors if you want to jump into our calendars. There's also an option to follow us on the LinkedIn page if you want to make sure you stay up to date on the different webinars coming up and any changes we have coming up with Chevron as well. Now we got just one question coming through here right now, and I'm going to wrap it up here real quickly. If you have any other questions, go ahead and give us a call, or if you put them in, we'll circle back to you because we're running a little bit late on this. But the one question was can I retire and change my pension annuity to my lump sum? So let me go back and clarify this. It depends upon the source of that question. If you've already commenced your benefits and you're actually taking that pension as an annuity, then no, you can't go back and change that to a lump sum, unfortunately. If you have retired and have not selected your pension yet, then you still have the option to choose either the annuity or the lump sum. And it's really important to give us a call to kind of go through this so we can run that cash flow analysis and show you both of those side by side. And that's one of the things we did with a lot of individuals over the last year. They retired, but we told them not to pull the trigger on the pension just yet because interest rates were dropping. As those interest rates dropped, we were seeing their lump sums go up because they were looking to take the lump sum. If If you're taking the pension as an annuity, the interest rates don't have an effect on you whatsoever. The other issue is your age whenever you decide to pull the trigger on commencing benefits. If you're under 60, there may be an age penalty there, so you're not getting 100% of the actual pension. So again, let's say if you're retiring at age 55 and you're looking to take the annuity, then we'll have a discussion as to whether it makes sense to take it now at the reduced benefit or defer that and get the full benefit. Or if you're looking at the lump sum, does it make sense to age out of some of those penalties and compare that with interest rate changes and how that's going to affect you as well. So again, I want to thank everybody for taking some time to join us today. If we didn't cover any questions and you want to reach out to us, you can call us again at 1-800-900-5867. I want to thank you. You have a great day and hope everybody stays safe.
Good afternoon, everyone. Thank you very much for joining us today. My name is Patrick Ray. I am one of the retirement advisors here with the Retirement Group, and we appreciate your attention this afternoon. Hopefully, we'll be able to provide you some value. We've got some interesting information on one of the most common questions we get related to your Chevron plan and specifically your Chevron stock. And so we're going to be talking today about net unrealized appreciation. And shortly, I'll bring on my partner and colleague Tyson Mayvar to cover today's material. But before we get started, there's a couple of things that we all want to be on the same page with. First and foremost, we are not affiliated in any way with Chevron, nor are we affiliated with Fidelity. And our experience comes with the people that we've met with over the years to help them achieve and maintain a successful retirement. And so the Retirement Group is a completely independent financial planning and retirement planning firm. And our goal is to educate you on some of the most common questions and concerns that we get from our people to help them achieve a successful retirement. And one of the avenues we bring to the table from an educational perspective is these webinars. And so you'll get a survey at the end of the webinar. And if you could do us a huge favor, one of the most important things for us is to get this content to you in the most advantageous way possible. And we really appreciate any feedback that you could give us with respect to the ins and outs of what you enjoyed or what you thought we could improve upon when we bring these things to you, so that you can really value the few minutes that you spend with us in a given afternoon to learn as much as you can about helping and getting to a successful retirement. And so you'll be getting some links in the chat today to get access to our recorded on-demand webinars that you can peruse at your own leisure. You're welcome to check those out at any time. And there'll also be a link to get time on our calendars in the event that you have specific questions and concerns that might come up. And we'll also be able to address those at the end of the workshop today. So if you do have a question, you're welcome to indicate that in the question and answer section of the chat box to allow us to address maybe at the end of the workshop. And that should do it. Finally, without further, before I bring on Tyson, I just want to mention that if you do have a understanding of your own circumstance and you would like to get a stress test of where you're at from a financial planning perspective, one of the complimentary services that we offer is a cash flow projection. And Tyson will talk a little bit more about that, and we'll give you information at the end how to get a hold of us in the event that you wish to take advantage of that. So without further ado, what I'd like to do is bring on Tyson to cover today's material. Tyson?
Yeah, thank you, Patrick. And thank you, folks, for joining us today. My name is Tyson Mayvar. I'm one of the Chevron-focused retirement advisors for the Retirement Group here in Texas. Today, we're going to talk about something that we found is incredibly important for a lot of the people that we've worked with over the last 30 years that we've been in business and working with people in the oil and gas sector, specifically at Chevron. It's related to the Chevron stock, which many of our clients leave the company having as a big part of their retirement plan, one of the larger assets that many of our clients leaving Chevron have when they retire and oftentimes maintain throughout retirement. So we're going to talk about a way to save on taxes that will probably help many of you on today's call. It might not be an issue for everyone, doesn't make sense for everyone, but net unrealized appreciation is a tax strategy we're going to discuss a little bit today. Those of you who aren't as familiar with us, Retirement Group's been in business since the early 90s, working with corporate employees. Chevron happens to be one of the companies whose plans we are familiar with and have clients going back several decades. And we feel very confident we are at the top of the list of people qualified to help employees of Chevron leave the company successfully, maximizing benefits, minimizing taxes, and putting together the most successful and comfortable retirement plan possible. Patrick mentioned the cash flow analysis, something that we have developed over the years specific to the Chevron decisions and retirement process. Encourage everybody to take advantage of it. It's a complimentary service. It doesn't cost you anything except for some of your time to gather the information and go over, whether on an in-person meeting, web meeting basis, or even over the phone, to go over some of the highlights and major important consideration that we find a Chevron employee faces. And everybody's a little bit different. So, your coworker may have different values and concerns in you, and may also have a different path to retirement and things to focus on. But once we get to know you a little bit better, we feel confident we can help to focus your attention on the issues that we've found are important to saving money, maximizing your benefits, and minimizing the risk of running out of money in retirement, which of course is a big goal for most people leaving Chevron. Here's the QR code to our LinkedIn page. If you don't follow us already, that's a way to keep up to speed with our upcoming content and keep up to speed with changes happening, not just on the Chevron benefits, but also in the tax code, which we're expecting soon, and other very important retirement planning concepts, such as estate planning, Social Security, the 401k plans, investments, and the current economy and politics. We're constantly trying to come up with relevant data, and that's a good way to follow us and keep up to speed with everything that's happening is through our LinkedIn page. So first, let's talk about what is net unrealized appreciation. You may hear about this through the abbreviation NUA. A lot of people talk about it. NUA, net unrealized appreciation, is NUA, in a way that you can save on taxes on your stock. Well, how do you do this? As it turns out, many of you may have Chevron stock in your 401k plan that's now administered by Fidelity. And if you do, you probably have two different versions of that stock. You'll have common stock and you'll have ESOP stock in many cases. Well, these two tranches of shares are different in that they have a different cost basis. So the price at which you or Chevron purchased these shares when they entered into your 401k plan, this is tracked by the company, by the administrator, in this case, Fidelity. And it's going to help us identify whether or not this is a viable tax strategy for you, or what type of tax savings you might enjoy by implementing this strategy. Essentially, what NUA is a way that you can pay a lower tax rate on your shares of Chevron stock. And the way that you do that is by, instead of moving your shares to an IRA when you retire, or leaving them in your 401k when you retire from Chevron, you can actually move those shares into a non-qualified account, such as a brokerage account, whether individually owned or maybe you own it jointly with your spouse or another individual. But a non-qualified account, you can move these shares out of the retirement framework in an effort to avoid future ordinary income taxes on these shares. Now, you'll still have some capital gains taxes on these shares, and the tax savings is a function of how low of a cost basis you have. The lower your cost basis on the shares, typically the better the strategy is going to be for you. And this is especially important for those of you that have the ESOP shares, because in almost every case, those shares are going to carry a lower cost basis. Most people we work with, the cost basis on those ESOP shares is about $11 a share. Whereas Chevron stock today is close to $100 a share, which is appreciation of maybe $90 a share. And it's in that appreciation that you can enjoy the capital gains tax rate. And the tax savings is also going to be a function of what your ordinary income tax bracket is when you sell those shares in retirement, which is also an uncertainty, as many of you are probably concerned with where tax rates are going in the US, especially with all the fiscal stimulus we've seen in the last year and really last many years. It's likely that tax rates are going to go up. And this is a big uncertainty and a big risk for many retirement plans and many retirees, is the uncertainty of what your ordinary income taxes are going to be when you pull money from your retirement accounts. Well, this is a way to improve the level of certainty by reducing how much of your assets are exposed to this unknown ordinary income tax rate in the future. Now, there are some special rules on how you implement this NUA strategy. So you can't do it until you retire. You do have some points where you can do it. They call them triggering events. And retirement is the first triggering event. You can utilize a strategy after you retire. And if you pull money from your 401k plan after you retire, you have to administer this strategy by the end of the year that you pulled money from that account. Otherwise, you will lose that triggering event, in this case, retirement. 59 and a half turns out to be another triggering event. So if you retired prior to 59 and a half, for instance, and pulled money from your plan, you still have another triggering event, 59 and a half, where you could get another opportunity to utilize this strategy. Now, if you happen to retire after the age of 59 and a half, you don't have that triggering event anymore. And if you pull money from your plan and don't fully distribute or roll over your 401k plan and utilize the NUA strategy by the end of the year that you pulled money out, the last triggering event, as it turns out, is death or disability, which, you may never be on disability in retirement. So that might not be a triggering event for you. And most people don't want to wait until their death to utilize this strategy. So typically it's going to be near the time frame that you retire. It might not be right when you retire. Some folks, we recommend waiting until the year after they retire, maybe a couple years after they retire, to do their rollover and distribute their shares through this NUA strategy, which also might be a function of the tax bracket you're in or how high your income was in your last year at the company. Sometimes, like a lot of the people that we worked with through the EOI, a lot of our folks that took a severance package in the last year or so had more income than we would otherwise like in the year that they retired, whether it was the people that worked half a year last year and then got a full year's pay severance package, a year and a half of their normal pay. Probably not a good year to add more income to your income tax. So for many of them, we waited until January to do their rollover, because one of the detriments of the NUA strategy is that you have to pay taxes on the cost basis of your shares that you're utilizing the NUA strategy with. And that might just be your ESOP shares, or it might be some or all of your Chevron common stock shares as well. But everybody's a little bit different, and we recommend running an NUA analysis so you can start to, under conservative assumptions, figure out how many shares you might want to utilize the strategy with, how it's going to affect your current tax bracket when you do the rollover, and also how it's going to improve, hopefully, your future tax rates and total taxes, so that you can minimize your lifetime tax bill. And again, it's not right for everybody, but in going through this analysis, oftentimes we find that it helps people to visualize this strategy, because it is a rather complicated strategy, but also see, is this something I need to rack my brain with over the next few years? If not, then you can just avoid it entirely. But if it could potentially reduce your taxes substantially in retirement, it's definitely something you want to focus on and maybe even plan for by contributing to your savings plan, potentially on an after-tax basis, to prepare for the extra taxes you would have just on the cost basis portion of these shares. So we've done an example here. Here we have a hypothetical situation. We have Lucy Norton, who had $200,000 of Chevron stock that we found in our analysis that would be a good idea for her to utilize this NUA strategy with. Well, the cost basis on those shares of stock was $40,000. So as a result, the net unrealized appreciation was $160,000, the difference between the current fair market value and the original cost basis of those shares. Now, we also make an assumption if she retires and continues to hold those shares, which oftentimes we'll recommend to our clients, don't sell the shares when you leave the company and utilize a strategy. You can do what's called an in-kind transfer from your 401k plan to both your IRA on the shares you don't utilize a strategy with, as well as your brokerage account or your non-qualified account for the shares that you do utilize a strategy with. So our assumption here was that after 10 years, her Chevron stock doubled, which would be just over 7% average return on her Chevron stock, which isn't too lofty of an assumption, I don't think. But it's now worth $400,000 10 years later. And we also assume that she sells all of her stock after 10 years for our illustration purposes. Now, that also might not be necessarily the way you go. You might slowly sell shares when you get certain good price points in retirement, or just to complement and supplement your income from your IRAs. But for Lucy's scenario, we assume that she's selling her stock 10 years after she retired and did the NUA strategy. Now, we also have an example here of the NUA method. There's 3 segments of your stock you want to pay attention to. So the cost basis, that's what you'll have to pay income taxes on the year you do your rollover, and also why you don't want to utilize a strategy with high cost basis shares. A long-term capital gains rate, that's what you'll enjoy on the net unrealized appreciation or the growth of the shares during your career, which in many cases is only 15%. For most of us, and that's compared to, some of our clients are in the 24 or 32% tax bracket, so it's pretty substantial savings for those folks. But then there's also something that the IRS and we as advisors pay attention to, and our custodian Charles Schwab pays attention to, which is the future appreciation on those shares after you retire. The significance of these shares is that, granted, you pay the same long-term capital gains tax rate on the future growth, same as you would on the growth you enjoyed during your career. But under current tax laws, when you pass away with an appreciated asset that's not inside of a retirement account, such as appreciated stock in this case, your beneficiaries get what's called a step up in cost basis, which actually removes the taxes owed for them on the future appreciation of these Chevron shares that you have in retirement. So this is an additional benefit to this strategy that, granted, there's still the primary benefits are in the tax savings you'll enjoy on the gains you enjoyed during your career. But if estate planning is important to you, if you're leaving this money to your spouse or your children or grandchildren or a cause that's important to you, perhaps, this is another additional benefit that might not be around forever. This is what's being talked about in Congress right now, is getting rid of the step up in cost basis. But it could be an additional estate planning benefit and a massive tax savings, especially if you have quite a bit of Chevron stock in your 401k plan, if you're still working. Here's the current tax brackets that they're constantly changing. These are probably going to change as soon as next year. And they're just depending on who's in office. And just depending on also our fiscal situation, we're likely going to see these rates go up. Maybe not on everybody at first, but probably on most people pretty soon. And so this could be an additional benefit to utilizing the NUA strategy so that you can have more certainty about your future taxes and not have some uncertain ordinary income tax rate that's going to likely be higher down the road. So here's our example. Going back to Lucy Norton here, we have the NUA strategy on the left, and then we have the what a lot of people would do if they weren't aware of this strategy is just roll over all their stock and everything else they had in Fidelity to an IRA after retirement and pay ordinary income taxes on 100% of those dollars. In the NUA strategy, Lucy is going to have income of $40,000 in the year that she utilizes the strategy, because that's what the cost basis of the shares she chose to utilize the strategy was. Now, her income tax on those shares is, of course, in the progressive tax system we have here in America. It's going to depend on what her income was from other sources in that year. But for her total taxes were about $4,600, or her effective tax rate was a little more than 10%. Her amount subject to tax when she sells the shares, in our scenario here, it was 10 years after she retired, is going to be the appreciation on those shares, or $360,000, right? Because we assume that those shares doubled in value over that time frame. She's going to pay capital gains taxes on those shares, which is going to be 15% on most of it, but she gets a little break on the first amount of her income, the first $53,600. So her total taxes due on the back end when she sells the shares are just under $46,000. And her total taxes paid, including the ordinary income taxes in the beginning, were just over $50,000. So she's paying taxes twice, but only on a portion of the shares in the beginning and on the other portion of the shares at the end at a reduced rate. Now, in the IRA rollover strategy, the benefit is that there's no upfront taxes. And so this is often why we want to get the timing right on this, because if you're in a higher tax bracket, we might not want to add to your income that year, and we might not want to utilize the strategy at all, or we might not want to just utilize it right away. We might defer the election of the NUA strategy. Now, on the back end, when she sells these shares, and we assume these are in an IRA, remember, she's actually selling the shares and then withdrawing the funds, which is what triggers the taxable event in an IRA, is not the actual sale of the shares, but the withdrawal of those shares. Now, of course, it's a progressive tax system, so her income is going to be taxed at different rates. And if her income was that high that year, part of her income is going to be taxed at the 32% current income tax bracket for somebody in that threshold. Her total taxes when she made that withdrawal were over $96,000. So her tax savings, given these assumptions that we made in Lucy's case, were actually $44,000 less taxes. Now, the longer you hold those shares, likely the better tax savings you're going to enjoy. Or if those shares do truly appreciate, which I know a lot of my clients that are holding on to Chevron stock right now are anticipating better growth in the future than we've seen certainly in the last couple of years, and hopefully better than the last 7 years with the challenges we've seen in the industry, which of course there's no guarantee of, but the more your Chevron stock appreciates, the better this strategy becomes, because that spread between the difference of your capital gains tax rate and your ordinary income tax rate is going to mean more for you the more valuable those shares become throughout your retirement. And that'll also create a better estate planning or better tax savings to your legacy or your estate, assuming that you don't spend all of these shares or sell all these shares during your lifetime. Now, it's a complicated strategy, and the value that this is going to bring to you and your family is going to depend on a variety of different circumstances, but we have to run an analysis to see what kind of tax savings you might enjoy and understand, first of all, is it something that you are going to benefit from, and how do we implement it for you, which is different for everybody. Unfortunately, 74% of Americans over the age of 50 do not have a written retirement plan. It's unacceptable, folks. There's no reason for it. There's a variety of groups out there, including the retirement group, in an effort to build a relationship with you and earn your business, hopefully, when you do retire, are willing to do this for you for free on a complimentary basis. It is going to take a little bit of your time, but we're very confident it will be a very good investment of your time, and will help you feel more comfortable about the things that you need to focus on, and ultimately when you can afford to leave Chevron and never have to work another day in your life and sail off into the sunset and have a comfortable life after Chevron. So let us know if you'd like to have us run either the NUA analysis or the full-blown cash flow analysis. The QR code here on the left will allow you to get you on one of our calendars, myself or my colleague Patrick, or any number of our Chevron-focused advisors around the country. Here's that LinkedIn QR code again if you'd like to follow us on LinkedIn. Or you can just call us or email us if you have just some quick questions or would like to set up a meeting and let us know a little bit about your situation, so hopefully we can add some value to your retirement strategy. We can be emailed at info@theretirementgroup.com, or you can call us at the home office at 800-900-5867. We'll do our best to help you out in any way we can. With that, we're going to wrap it up, but stay tuned. We're going to be talking more about our investment philosophy at the Retirement Group, which we think is an important way or philosophy to keep in mind when you're investing for retirement, which is value investing, buying good assets at a good price, and being very particular with the stocks that you own in your retirement portfolio. And we're going to be talking about that more and more as we get through the second half of this year, 2021. So with that, I'm going to pass it back to you, Patrick, in case you have any last minute thoughts or any housekeeping issues that you'd like to talk about before we wrap it up for the day.
Yeah, thanks, Tyson. As you know, this is a complicated strategy, and I think you hit the nail on the head when you talked about the planning aspect of things. And look, it may or may not be a particular, scenario that you should be aware of. But the reality is the planning process helps. And so even if NUA doesn't apply to you, we'll be at least able to, share with you some ideas and things that are relevant so you understand the process. And then you can basically say to yourself, you've understood and kind of did some homework and an analysis to find out that NUA may not be a strategy for you. And then you can just simply move on. So we feel like it's a valuable tool, as you had mentioned. And so feel free to reach out to us, but I think we'll call it an afternoon. So we appreciate your attention, and stay tuned for the investment webinar that we'll be doing as a follow-up. So we appreciate your attention this afternoon. You guys have a great day.
Thank you, folks.